Welcome to Crestview at the Cave podcast, where we explore the world of real estate and insurance like never before. I'm your host, Josh Berkowitz, and I'm here to make sure you get the settlement you deserve. Today, we have a very special guest joining us, Marc Hershberg, all the way from Miami, South Florida, managing partner and CEO of Topaz Capital Group. Marc is responsible for overseeing the origination and structuring of all of Topaz's investment activities, as well as acquisitions, business development, investor relations, and overall strategic direction. Topaz's background is a leading private debt and equity real estate investment firm, which focuses on the acquisition and development of multifamily and residential properties, primarily across the southeastern seaboard and secondary markets with a concentration in Florida. So get ready to strap in and learn something new every episode with me. Strap in, you know what I mean? Josh Berkowitz and my guest at Crestview at the Cave podcast. Let's get right into it. Thanks for coming.
Thank you for hosting me. This is fantastic. I'm really excited.
I know you made a long trek here from Florida, so
it's good to be up here. It's also a good excuse to get out of the Florida unbearable heat. So thank you guys. I've also been tracking your career. It's amazing to see how we just started a few years ago by helping people in the Carolinas coast. They got flooded, and you were a big part of that sponsorship. So thank you for that. That was really incredible. And at real estate, people are asking me before the podcast, like, why are you talking about insurance? And I think one thing to understand is that real estate guys, owners, operators, sponsors, if you will, have to have a knowledge of insurance now more than ever. Before, you kind of just relied on your insurance broker, your insurance advisors, your risk mitigation team, if you will. And, those days are no longer, those days are behind us. You really have to have a pulse because new acquisitions are so heavily reliant, as well as executing on your business plan, because no one pro forma'd that the insurance world was going to, end up in today's state of the market and volatility. So I'll kind of talk a little bit of the background of multifamily investors' hardships in terms of insurance. We're obviously facing an unprecedented time and challenge here, with rising commercial property insurance rates. Due to primarily weather-related losses and rising construction costs, specifically in Florida to do with wind and named storms, among other factors. Respondents to actually what's known as our industry, research and really our main leader in terms of how thought leadership of housing is National Multifamily Housing Council, the NMHC. And in their 2020 State of the Market Risk Survey, they actually noted that insurance costs surging an average of 26% year over year nationwide. We're identifying even higher premium increases in the target markets that comprise of multifamily investments. And specifically in the Southeast where we are, and we have a strong footprint in Florida amongst a few thousand apartments and growing, we're finding that insurance is a deal, make it or break it for the first time ever before. So what we're going to get into is why is this happening?
Yeah.
And what steps are we taking to mitigate those increases, part of our risk management strategy, and obviously the role that public adjusters are playing in this are imperative, given that, for the longest time, insurers were saying, hey, you could, reach back us out later, or we'll kick that can down the road for the one who, had the loss, if you will. So I think it's just a really opportune time. I don't think there's a greater opportune time to have this conversation.
100%. And you mentioned, I always like to bring things that are relevant. You mentioned you had a lunch yesterday and you overheard some bank discussing, what's going on in the market.
Yeah, so one of the biggest servicers of multifamily across the country, we were in lunch meeting yesterday, and they mentioned that over the last 3 years, we've saw more global losses than we've seen in the last 3 decades. What that's done is it gave a whole new perspective to the insurance companies and saying, guys, we've taken on so many losses just in the near term. What are we doing going forward? What does that look like? Does the Fed step in? Does the state step in? If so, how much could they step in to really help alleviate the pain on us landlords?
Well, it's actually interesting. In Florida, wasn't really a topic to speak about, but you read about the news recently that the state of Florida was raising bonds so they could pay out insurance claims from Hurricane Ian. Right. So certain states probably they want to help out policyholders if they can.
Yeah. I think there's a certain element to them waiting to see what the Fed does, because the federal government is willing to help match in a meaningful way and step in and help alleviate the pain. It's not all falling on Florida, which, is obvious, is arguably one of the biggest development states across the country.
Sure. No, it is. I guess let me take a step back. I'm actually curious to, and I've known you for many years, but want to hear, how do you get into real estate? How do you start Topaz, and how do you focus on the Southeast and specifically Florida now?
Great question. So I'll tackle the latter first. Florida was a natural progression. We call it the sixth borough of
Sure.
New York. Just having older relatives and people in the family, and always traveling there. As a kid growing up, I had a lot of exposure to South Florida. It's ironic that we actually primarily outside of South Florida. We're almost exclusively central and northern Florida right now in terms of our footprint and portfolio.
Because you can get better insurance there.
Right, exactly. You get better insurance, you're gonna have less fierce competition for certain assets, and you're ultimately getting better yield for your investors. So that's kind of where we looked at it. We also have fundamental issues with South Florida being more of a safe haven of capital rather than actual. Also, the jobs are everything in multifamily, right? So if there's organic job growth and creation, that's healthy. If it's not, then it's just flight of capital or wealthy people parking the capital, or what they call sometimes Florida's where capital goes to die in Miami, at least. So that's why we've stayed out of it. There's fundamental reasons, obviously, within that calculation in terms of within the economic calculus that we took, that we just didn't feel it was worth the risk-adjusted reward when our tenant up in Orlando or Jacksonville or Lakeland, Tampa areas, or the Space Coast for that matter, they're the same profile, same jobs, but the guy down in Florida is getting squeezed and paying twice the amount of that.
Sure.
And so in South Florida, right? So that was something from a fundamental econ standpoint that we struggle with. And so we're kind of waiting to see what happens to the market in South Florida. Now, to answer your question on how we got into multi and how I personally got into the space, it was primarily through the banking realm. I was at UBS, worked on, kind of got to touch a lot of different desks, from wealth to CMBS to structured credit and so on and so forth. And so when I saw the CMBS desk or actually on all the desks, there was one underlying denominator, was real estate as an allocation, whether it was billionaire family offices with a large allocation, whether investment side, whether it was on the CMBS side, helping structure some of these mortgages, whether it was a structured credit and helping them, loan workouts and structured finance, and helping, borrowers get out of, called precarious situations. That was really my exposure. And then obviously that led to my about 3 to 4 year stint at Brick Capital coming out of the bank, and felt like my entrepreneur.
It's a New York City based.
New York City-based firm, Brick Capital Group. Shout out to Joel and Eric and George, who really taught me the business. Specifically Joel, who gave me a taste of ownership. Joel Radman, and he's one of the principals at Brick. And when he was teaching, he gave me that taste of ownership that I think was so great that I had to keep on going. And that's really ultimately when I said, you know what, I think this is time I try to find a partner out there that complements me and that I know through my network that could help bring a more of an ownership platform and focus on our own deals as opposed to the deals of my employer. And that's basically how it worked out, as we came to agreement on that. And since then, we haven't looked back. 2018, we haven't looked back since. And my partner was an acquisition guy, Treetop, by the name of Eitan Freeman, and he actually brought a tremendous amount of value because he got to touch a lot of different aspects of Treetop development and a lot of what they do. So
Sure.
Until now, we give a lot of credit to Ozzy and Adam for always helping us, being in our corner, as well as a lot of other mentors along the way, as well as Joel continuing to always have a voice and an ear for us. So,
How is it going from New York City real estate down to Florida? Like, do you find people in New York are more aggressive? Like, is it easier to close deals, or it's really equal playing field down there?
two different worlds. I thought initially that they were going to be quite similar because there's a reciprocity and such a commonality between those who are coming into Florida and coming into New York and the types of profile of people you're dealing with, families. But in fact, it's a very different landscape entirely. Down there, specifically in our space, we're mostly community driven, so garden style. People are coming in to, really live a quote unquote suburbia lifestyle within a greater MSA, greater metro area. So that deal making is entirely different. The aggressive approach I had to pull back from.
So it doesn't work.
It doesn't work.
Really?
It just doesn't. Yeah, it didn't work.
I'll tell you, it works when I'm settling insurance claims in Florida. It's different when you're probably buying real estate.
Yeah, so when you're buying real estate, you're cultivating the relationships, right?
Sure.
So if you're going to come off as an aggressive New York buyer, which a lot of 2021 to 2023, the market was dominated by those buyers and California buyers as well. In the beginning, when we first got started, 2018, 2019, we got in early. A lot of that can be credited to just pure, luck. And some of that's credited to us seeing the value of Florida, and the legislative constraints going on in New York, LA, and elsewhere, which ended up in rent control and all types of other complicated issues and at the time, headwinds for multifamily owners. So a lot of what we have really been focusing on is taking a step back from the New York approach, staying aggressive in terms of our discipline, in terms of, chasing deals and persistency, but the aggressive tones and the aggressive, I want this done by 24 hours from now and close.
Not gonna happen.
That's not happening. It's just, it hasn't happened. I will say though, since COVID, because a lot of folks from New York moved into Florida, it doesn't mean the brokerage community has shifted tremendously to New York, from New York brokers to Florida brokers, but it sure has been, we sure have seen more of a, let's call it an understanding and patience with the New Yorkers, like ourselves coming into the market. Yeah.
It's definitely interesting. I guess from there, as the market's changing, like we as a company do work in Florida now. The insurance market there is crazy. From handling claims to even buying insurance. We have some clients buying properties right now, and they're doing some interesting tactics to, when they're purchasing a property. One of the things I want to share here with you was I recently had a client we're handling a claim for in Daytona Beach. They had some type of property damage there, and I was asking him, like, how did you just purchase this 100-unit property? Like, the insurance market is crazy right now. He said, and this is not advice for everyone to do, but you have to look into it to see if it works. But basically, before he's looking, if this is the new property he's looking at, from Marc, he gets the insurance policy from Marc, your current policy, while he's in due diligence, and looks at the policy. The replacement cost might be a little different than your current purchase. He'll call your insurance agent. Every insurance agent wants to keep the premium of the policy and say, hey, Marc's agent, I'm interested, I'm going to be purchasing this property. I'm interested in, keeping this policy. So what happens then at closing is the agent is inclined to keep that policy. So they just able to change the name insured to him. Right. I've spoken to attorneys and different people that people say different things, but for him, what's working is the fact that his premium is staying the same when he purchases.
Right.
So he might get caught up in the next renewal that it might get, higher, but comparative to like new policies, which he's trying to get, it makes the world
for the life of the current policy. And that's a great point. What we found is that it really only works well in MIPAs. So in membership interest purchase, for those who don't know, membership interest purchase agreements. MIPAs are a fantastic way if you really understand how to do entity searches and, understand what liabilities come along with the property that runs with the land, if you will. Those are really good situations that you could step in, and then because you bought the entity, the insurer and the lender and everyone else isn't down your throats about, hey, we have to renew this today. So we've seen it pretty successful. We've seen it work successfully where it's a MIPA transaction. We haven't seen it so successfully in a typical arm's length transaction.
Yeah, I have to find out the exact details. I'll share them with you. Yeah, it's interesting. I think it may have been something like that. Interesting LLC, or maybe even like in a trust.
Right.
And
those
that's what it was.
Yeah, and trust
wasn't a typical LLC purchase.
Correct.
And that was a whole different reason how he was buying things in trust.
Right.
That's a tax saving.
Right.
Else.
Yeah. The only question is does it make sense? Right. Right. Exactly. They could be going for days on that subject, but I think to your point, you'll find guys that are saying, "Hey, I just want to wipe my hands clean. I don't really want them sitting on my policy. There's too much risk today with policy." So you have to. It's really seller dependent, is what I would say. And some sellers are creative to it, and some sellers are, couldn't be more far from creative.
No, it's a good point. I mean, since we're on the Florida topic, what's your perspective on the market right now? Your perspective on the market and like 2023 and beyond. insurance playing a role in that?
We kind of have an optimistic approach. We believe that given where the market is today, this is part of our thesis, is that a lot of folks are, and this is what we're telling our investors, is that how much worse can it get than right now? And guys, some guys are saying, well, another 2 named storms this season, or 3 will keep us at the same level, if not worse. And I'm saying to them, well, hey, let's not forget what probably arguably the most important point of all this, which insurance is essentially a pawn in what's DeSantis's presidential election. And we all know what he can and can't afford in terms of this upcoming election. And I don't think he could afford a massive fallout of commercial property throughout his entire state, when that was something a lot of his supporters have obviously backed him on to date. And that was something he's been strong on in terms of the most recent bill that he passed, amendment that he passed to avoid the rent control issue that Orlando put on the ballot most recently. So he's always been pro-landlord, pro-business. So it's going to be interesting to see how he negotiates with the federal government and his own state legislators in terms of mitigating this risk. And so we're kind of seeing an opportunity in the near term to actually get arbitrage, to gain from the arbitrage of insurance.
And if they're not going to be like doing rent control in certain cities, if you have properties in those cities, you may be able to increase rents.
You could not only increase rents, but I'm actually taking it a step further and saying, well, actually, I think on the next renewal, you'll capture 10 to 15% lower on the renewal rate, because there's going to, at a minimum, 10%, because what we're seeing now is there's only really one carrier, it's AmRisc. Everyone else has to be layered in policies and so on and so forth. So if the federal government and state government actually step in a meaningful way, which they're being pressured to from a political climate, it almost seems that there has to be some sort of retraction in terms of renewal rate increases. So I think we'll recapture some of our exorbitant increases.
They came out with some, I don't know the exact law, like right after the hurricane in January this year, they came out with some legislative stuff in Florida, and they were pushing the insurance companies in Florida to have to respond quicker to policyholders. They also removed the whole attorneys charging the insurance companies fees. So the whole market's changing. But one of the things they also did was saying that there's going to be a limit on how much they could, increase premiums. And then I'm still talking to owners. They're like, my premium is still insane. I don't even
200-300%.
We're not really sure where the limit is. So it'd be pretty interesting if the federal government gets involved. I don't know if they ever will. I mean, who knows?
No, who knows? But at the same time, we can't forget that one of the 2 top contenders for the president of this country is someone who has a highly vested interest in making sure that
if he could pull that off, that's
a testament to his leadership, right? Yeah. So. And if he doesn't,
name storms to start for him, because then he's totally screwed.
Right. Name storms are going to be really tough. To your point earlier, you mentioned Hurricane Ian. It's funny because Hurricane Ian is only one of many hurricanes that hit us in the last few years.
Sure.
But that was the catalyst event, or the main storm that started to have insurers question whether it makes sense for them to continue.
Well, right. One of the first 2 guys. People I brought into the podcast was an attorney that I work closely with, and we work with other attorneys, but he brought up a good point. He's like, a bank, it was right, we had a conversation right after the bank failure of Signature Bank and other banks. So one of the topics was like, okay, insurance failures. He's like, first of all, insurance companies and banks are all regulated by the same, folks. He's like, every insurance company is always one storm away from closing down. Like, you don't know their books, but and that's what happened in Florida. Like in Hurricane Ian, there were a few insurance companies, UPC is one of them, that, they got slammed. And now all their stuff is with FIGA. Now we have to deal with FIGA right now.
Yeah, it's all one governance body. And that's the interesting point that you're bringing up here, I think, is that, with that overarching governance body, there has to be, especially in a bank, what they call a banking crunch, not what they call a crisis crunch, is the terminology people are throwing around. You're seeing people to, look at things entirely differently, from the sense that, now banks have to not only, work with their borrowers, but they're also in commercial real estate borrowers, but they also have to put up more liquidity now. So they have to put more liquidity back into the bank, and who knows how long rates are going to stay where they are. And so that's the challenge that I think in the near term we're going to see developers saying, hey, well, we wanted to wait, lend and extend, as they call it, or we wanted to kick the can down the road for you another 6 months, but we have to invest back in our own bank. And so what does that mean for us? Like, we need to recapture our recycled, we need to recycle and recapture those dollars that we put out. And so, and that arms them with more capital to then go either raise more capital for the bank or recycle back.
I had a client this morning. I was on the phone with someone trying to, we handle property damage. We also handle the business interruption portion of it. So, losing income, whether you're a business or investment property. So a client had a hotel, they converted to residential. They were supposed to open up January 15th. Like, to have the C of O. They also had a term sheet signed with the bank to refinance, to go from a bridge loan to regular loan, and they had a large loss, multi-million-dollar loss, and that document for the loan went out the window. We got the claim settled very quickly, thank God, but they were able to rebuild it fast. But I just spoke to them this morning; they're still unable to get a loan because they're still in that bridge loan, and the interest rate market, from December 28th, whenever they had that document signed, to now, it's like a different world. So they're totally difficult.
We've jumped a lot. I think we jumped north of 100 bips since then. So it's everyone's feeling the pain. We're feeling the pain, candidly. We're fortunate that we're not high octane leverage kind of group. We're not facing the type of strain that a lot of other folks are. And also, we typically go with your more conservative agency type lenders, where other guys are with debt funds that look past these things. And these things are becoming, when I say these things, these pain points on insurance are becoming so real that you can't look past it anymore. And that's where we think a lot of folks are going to be struggling, currently struggling, but continue to struggle. I think the question then becomes is, how long would it take for other carriers to come back into the market? Do they want to come back into the market?
It's a good question. We spoke offline about that, and I spoke to a couple different, different professionals, get different perspectives. One of them was an actuary who works for insurance companies. So something interesting he said was that in the state of Florida and the state of California specifically, there are obviously a few big insurance companies that stopped writing insurance. They're in Texas, in California, there's different reasons why they stopped. Besides for the wildfire, supposedly the landscape there with the government, it's really hard to get. Insurance companies are in the business of making money. So it's very difficult to get the state of California to agree to a increase in, if we're going to say we want to increase the premiums by 20%, they limit them. Right. So I think that's why State Farm, basically, one of the reasons was they just said, okay, we're going to cut the cord right now. It's probably political for them to just get, the government to do that. But in Florida, one of the main reasons is that's that stat you brought up in the beginning of the 40% increase. It's because of all the hurricanes the past 5-6 years. So there really has, in order for other companies to go back in, and there will be other companies that are going to go back in, new companies. There are going to be new opportunities. To your point, there might be better premiums, but there has to be a year or two, especially in Florida, where there's no name storm. If you go this summer and there's no name storm in Florida, I think next year, according to what he was saying, because he's the actuary for the real insurance companies,
sure,
there might be some new players that start exploring Florida again.
Right.
And then the reason why is because every insurance company goes to the reinsurance company to get insurance.
Right.
You have interest rates that are rising right now. Cost of construction has gone up a lot. So that's also factors that have got into this place. So who knows? I mean,
I think one other thing we could actually throw into the mix is that, we also, everything's relative to what else is going on, right? So meaning, in other words, everything is relative, right? So if you take Florida and you're saying, well, there are Midwest states this year that had tornadoes that no one ever fathomed could happen.
Sure.
There's Sunbelt states.
Or also this storm is called Derico. It's like a storm. They just had it like 2 weeks ago. They also had it last year. It's basically like a hurricane in the Midwest and farmland. It's like hurricane force winds, these crazy events that happen.
These are unparalleled events. So what then happens within those states? How are insurers going to look at that state? So if the higher risk comes if all ships rise and all ships sink, right? In many ways for the insurance. So if the rest of the states are going to see higher risk exposure for those states, then Florida actually might look pretty good. Southeast might say, well, actually, you're looking good because, yeah, we know you have named windstorms, we know you have some flooding, but for the most part, you guys are used to that.
Yeah.
So the infrastructure, the way things are run on the ground, at least are used to it, whereas in other states, they don't know how to react. Take one example, upstate New York on Sunday night, right?
Flooded.
They just got completely flooded. So what, they didn't fathom that, and so that's why a lot of highways just crumbled underneath because of the runoff of the water. So,
I think one of these are really good points, and we spoke to a couple of people that called us, and we obviously upstate New York is our backyard here, so we spoke to a lot of people got flooded and tremendous amount of damage, but a lot of people do not have flood insurance, so they're probably in trouble.
Right.
But one of the things that people have to think about, whether you have a house or even a commercial building, even if it's not in a flood zone, consider getting flood insurance, right? Just consider, these days, I'd consider, because you have all these storms that come through, and all you need is 2 hours for there to be 8 inches of rain. Like that's what happened in Stony Point, New York just now. So, and no one had flood insurance there, but if they had flood insurance, they'd be covered. So think about your portfolio and think about, consider, even though it's another thing you have to pay money for, but think about how much more it's going to be to get flood insurance, and talk to an expert, talk to myself, talk to other guys out there, other people out there, get a perspective, right?
Yeah.
And then another thing which I was reading about recently, obviously it's not new, but everyone in Florida and other areas around the Southeast, when you have hurricanes, like a lot of people they're only concerned about cosmetic things for their properties, like, inside the property, maybe the roof, but not really. Like, it's time for people to wake up and start protecting their property.
Right.
So stop worried about the cosmetic things and worried about, like, if you have a storm that comes through with 100-mile-an-hour winds, is your property going to be stable?
Right.
So people are going to I think this will just change. Like, people are going to have to start worrying about
perception. Adjusting, though, is another question, right? Like, how long does it take for people to actually, feel like this is such a real threat? Yeah, that takes time, right? Adaptability is a huge factor.
From our business, obviously, we prefer a property that has, like, it's going to get rocked from a hurricane or something, but there'll be enough damage out there for us, trust me.
Yeah.
So it's important for owners to really consider their properties and say, okay, could this sustain like a hurricane, something significant,
Yeah, and then to your point, I think that the sector of risk management for property insurance is going to be very profitable, probably starting to hire up and ramp up more hires is my guess. What's going on right now, I don't know for a fact.
There was an article in the Wall Street Journal a couple months ago about, like, one of the Lloyd's of London, someone had one of the largest departments in their insurance company was a consulting department that basically goes out for not like an owner of like $100 million of real estate. It's owners, like the people, it's like the Fortune 500 companies of real estate, like along the ports, and basically they go out as consultants and just to inspect the properties, make sure they could sustain damage. One of the things they noted was kind of interesting. I thought it was a property that was like by the Newark seaport or somewhere, and during Hurricane Sandy, the place got flooded because it didn't have enough drainage on. So those are things that they'll proactively go out and look out for owners. But even if you're a not as large as Fortune 500 company, those are things you should be doing.
Right.
Like at your property, because we always see.
And usually, by the way, usually most, and to your point, most folks, especially in the insurance world, if you're giving them the business, they're going to help you on the advisory side. They're going to help you in the risk mitigation side. Sure. So management mitigation, whatever you want to call it. So lean on them. Lean on
Sure.
people like yourself and say, okay, well, what does that look like? What has been a major issue in this area in the past? Or if it hasn't, because right now we're seeing unprecedented situations. So you can't look at historical so much anymore, which is a scary thing for a lot of folks, which is hence why we're dealing with this crisis in the first place. But, at the end of the day, I think it's going to be looking at and saying, okay, well, if this does occur, what then does the liability scenario look like? And I think that's for the first time, and I think ever, to my understanding, and talking to legacy families, multi-generational real estate families, that they never had to run scenarios of how would our damage look in an area that's never seen that kind of damage before. So it's a new perspective, as well as thinking about, like we said earlier, adaptability and how long does it take for people to really take it seriously.
So, these are good points. One of the ideas that I had before if you have any questions for me was,
Sure.
one other question for you is,
Sure.
I don't know how many claims you guys have had in your portfolio in the past, but if there's an example or high level, like from an owner's perspective, right? I know how to handle the claims. I know what happens with the dollars and cents, right? But from an owner's perspective, you have a significant loss of your property. How do you manage that? Like maybe that'd be cool to.
Right. Yeah, from an operator standpoint, I'll talk about it from an asset management and ownership standpoint more than operator, because I feel like getting in the weeds on operations is probably not my strongest suit. But yeah, from a high level standpoint, bird's eye view, I would say you're really looking at an environment whereby us as owners, and sponsors, we have to now say to ourselves, okay, coverage has to be potentially even greater than it was before. Now, the problem we're having, especially in the state of Florida and the Southeast as a whole, is that the insurance companies have increased rates up to, call it 95 or newer product. You're talking about $1,800 plus a unit on insurance. So if not higher, and then anything later than that probably won't get insured. So if you're lucky, right, you throw it on a master and try to finesse it, but you don't really have adequate coverage there. So I wouldn't say adequate coverage applies to older product as much, unless you do what we said earlier, the MIPA structures and all types of other things, to buy time with good coverage. So the problem that I was actually going to want to dive into here is that, we're really seeing for the first time ever, a hyper focus on sponsors getting quoted by their insurance providers before they're even submitting LOIs. Before they're even submitting offers to sellers, you're essentially trying to get some idea of what your cost really is today.
Tee that down.
Tee that down. And that doesn't mean that, in 3 weeks, 4 weeks, 5 weeks from now, as you get closer to, the end of your DD period, that you're not going to walk into a higher quote. That's what's been happening.
It's crazy, yeah.
So I had a guy the other day tell me, hey, he got quoted at $2,000, but at the time he actually got to the end of his due diligence period, he was at $2,500 a unit. So it makes a massive difference, right? Because that's real bottom line stripped out of NOI cost. There's nothing you could do about it. Plus, the lender's probably going to reserve for it as well. So there's really nothing you could do other than
saying if you looked at a deal 2 years ago, this is not part of your due diligence or part of other owners.
It was part of due diligence, but it wasn't like we need a quote.
Maybe just talking to the broker, be like,
exactly.
Hey, where do you think the market's at?
Exactly. Actually, brokers were the insurance brokers. It was the insurance advisors, if you will.
So I have to go to the actual carrier saying.
So now insurance companies, brokerage companies, leading groups that were very close with Berkadia, CBRE, Cushman, all these guys, go on for days of all the different groups that are playing.
Well, I meant insurance brokers. That's what I was.
Right. I'm saying, but back then the broker was the insurance. The broker was basically your insurance broker, and now today, brokers, for the first time ever in the last couple months or several months, they're including insurance quotes within their offering memorandum.
You better check those.
So you better check them and say, okay, well, now they're providing it to me. Obviously,
I remember
take it with
being a broker in New York City, and insurance was a line item, but it was never it was a line item.
It was a controllable line. It was a controllable line item.
I'm so curious seeing underwriting right now on these properties. It must be.
It's a moving target. So that's what I was saying. Is a controllable line item is what it was I remember when you were doing a lot of New York brokerage, and I was doing a lot of lending and brokerage on the side. Is we were in a totally different climate in terms of looking at insurance, because we said, okay, it's maybe changes plus or minus $20 by the time you get to closing. If in a worst case scenario per unit, $20 per unit per so per annum. So that's no longer the case. It's a moving needle. It's a moving target, and the needle's being shifted tremendously. So that's why now, to really understand where you are and then say, okay, what happens if it's a 10% increase versus now? That could be the difference of a make it or break it deal, because if they go back to the seller and say, hey, make it or break it for insurance, right? I mean, quite literally in your world on the break it side. But it's really one of these situations where we're now having to think about, does that seller, is he hypersensitive to the fact that if you come to retrade me based on insurance and that was something you were supposed to do up front, I'm out, I'm walking.
Yeah.
So there are sellers like that are not so sympathetic or have rather empathetic to buyers in today's market, to the insurance struggle of buyers and rising rates in the market. So that's something that obviously we'll see how it unfolds, but it's moving faster than the due diligence process itself is.
Definitely. Any questions that you had that we could answer? Obviously, you coming on.
Sure.
I know there's some.
Yeah, I would love to. Yeah, I'd love to get a sense of, and then we'll get into a question we actually got from a question and comment on LinkedIn from a couple of folks that we'll address in a second. But maybe you could kind of answer, how you're seeing, true replacement costs nowadays, being that, construction costs has shifted so dramatically. A, B, land cost in a downturn market is shifting. So how are you kind of seeing, true replacement cost, if you will, from the eyes of a lender and insurer?
Sure. I mean, so we look at, like, when it comes to replacement costs, we're getting called in, like, if someone had a fire at their property, right? We're not necessarily underwriting the replacement costs, but, if somebody in the actual insurance policy, there are sometimes, like, added, definitions that will include, like, this will be your replacement cost, $3 million plus inflation, plus number for inflation. So those are things in the policy you have to be careful for.
Right.
To make sure, like, if the actual cost is, $3 million, to make sure that you have added with inflation and the rise in prices, God forbid your property break, you're only worried about really replacement costs is if the property burns down to the studs. Otherwise, usually you're going to have adequate coverage if you have a certain loss. But if you have, if the property burns down and you don't have the adequate coverage, then that's where replacement costs really comes in. So you want to make sure that your broker is selling you, like, you have to look at through the policy to make sure you have the extra, it could be like 20% plus replacement costs. Like, I've seen all these different things, but those are things you want to make sure you have.
Right.
To make sure, God forbid something happens, you have the coverage to replace it all.
Right. So you sensitize it to a higher level to say, okay, if construction costs stay or continue to rise, at least you're able to really cover your.
Yeah, and also a question we've gotten a lot was, this happened during COVID especially, is we had losses, we're handling a commercial loss for somebody, and it was like the beginning of COVID before the rising price of lumber went up.
Right.
So we started the claim in like January. Let's say it was a $500,000 claim then, but all of a sudden we didn't settle the claim for, sometimes things could be, taking a couple of months. We settled 4 months from then. Within those 4 months, the rising price went up a lot.
Right.
So everyone's like, what are we going to do?
Right.
So we actually got the insurance carriers to agree to the increased costs in construction.
Wow.
But that's because we were able to read through the policy and we found out there was no exclusion.
So, okay.
Like, you really have to have an expert. Like, sometimes the insurance companies are getting smart.
Yeah.
If you don't buy
they have to.
Yeah, listen, they want to make money, If you don't buy the right policy and then speak to your broker of, like, adding the specific endorsements in, that's what it is. To add the endorsements in, you could be in trouble.
Right. And yeah, that I think it's a perfect segue for me to talk a little bit about, like, the trend of this global insurance losses, right? Let's take it from 2012 to 2022. Inflation's impact on insurance and reinsurance, like you mentioned, is not only material. It really, you're seeing the rates increasing claim costs through inflation. You're seeing, while at the same time reducing those that purchasing power of the investment income for the reinsurance provider. And then on top of all that, these factors are contributing to higher premiums for the policyholders, like ourselves on the properties, as insurers, are targeting and working towards maintaining profitability in an inflationary environment. So the inflationary environment's not only applying stress on the materials we're buying, it's applying then indirectly stress on the carrier to also, make sure that they actually believe in their assumptions. And so that's something that's really interesting. We touched upon the rapidly rising material costs and labor costs. We didn't really touch so much on labor costs, but that's also something worthwhile mentioning, is that labor's harder and harder to find in construction.
You can't find anybody.
You can't find anybody, right?
Yeah.
So, and I know in our properties, we're struggling. I mean, fortunately, we have, name brand operating partners and we built a nice reputation, but still we're finding we're still struggling to find the lower hanging fruit, if you will, and paid employee.
Regular labor.
Regular labor is like a maintenance tech, a punch unit turn guy. Just the basic, the jobs that we used to pay $16 for an hour, which we're now paying close to $30.
It's too bad ChatGPT
Can't solve this.
still need to have like the regular laborers to maintain the property. You know.
Yeah, it's not like a robot's gonna enter your apartment and punch the unit or fix your fix whatever the leak is or problem is, right? So there is that real genuine concern. To quote Arbor, one of our lenders, is that this is a real issue across the country, until lower paid labor and employees at on-site properties are readjusted back to earlier minimums, everyone's going to get tight, more constrained. So the lender, your debt service coverage ratio on the property is getting squeezed, and on top of that, you already have everything else getting squeezed. Your insurance is getting squeezed, right? Your values are getting squeezed because of the rates. So, it really does feel like a time whereby if you don't have a real handle on these issues, you're going to walk into a very problematic scenario.
You need to have an expert on your side.
Exactly. So that also brings me to my next point, which is actually a question for you: is what would you say is the best time to get a public adjuster involved with the property claim? And also kind of twofold question. And then B, what would you say is the timeline that they could expect to save on getting those dollars hitting their account from the time that the claim was submitted?
Sure. So that's a good question. Obviously, we've gotten that many times, like different ways, right? So we don't only, as a public adjuster, we don't only handle like the claim and manage the claim. We also like work with owners and developers, reviewing their policies, reviewing their coverages, because every broker is great in their own way, but brokers are not experts at reviewing policies and coverages when it comes to claims.
Right.
The larger brokers have a claims department, and not to say a bad thing about them, but we just specialize in reviewing policies.
Right.
So we're experts at understanding the policy, understanding every endorsement in it. And the way I got trained in this business, was to understand the policy better than the insurance companies. So we're talking to insurance companies. We're actually showing them the actual endorsements, pen policy language. That's going to help our client at the end of the day, right?
Right.
And then when you actually, if God forbid you do have a property, damage claim, the best time to get us involved is before you even call your insurance company.
Right.
And that's to allow us to, one, inspect the property for you, to get out there to scope it, to let you know if it's even claim worthy. It might be a situation where it's below your deductible and it might not be worth putting a claim in.
Right.
And then if it is a claim worthy claim, we advise you on that. We get hired and we work the claim. We don't only maximize the claim, we're managing the claim as well. So we're from opening up the claim to closing out, the owner does nothing. It's all in the hands of us and the experts that work for us.
That's incredible.
In terms of like timeline of when owner could see dollars and how much extra we get, I can't even answer that.
So case dependent.
That's so case dependent. We had a $3 million claim this year that we settled in 90 days. And then I have a multi-million-dollar claim that took 2 years.
Right.
So it really depends.
Right.
A lot of it is the personalities that we're meeting on site. We try to maintain a very professional, correspondence with everyone in the insurance, world. So when we meet people, they see us and they like working with us. So a lot of people think that public adjusters are like the devil.
Right.
Really not. A lot of insurance company adjusters and building consultants, when they see that there's a public adjuster on it, they're actually really happy, because then they're dealing with someone that understands the whole process.
There's a mutual sophistication level that's shared, right? That's critical, and that's really interesting.
I mean, think about this. I'll give you an example. Let's say you're negotiating a property deal, and you need to close the deal, and would you rather speak to the client's attorney? Would you rather speak to the client, the real estate owner, face to face? Like,
sure.
Who are you gonna get a better deal with?
Sure.
From my experience, if you start speaking to the attorney, and you're the real estate owner, and you're the other guy, you're not gonna. I don't think you're gonna come to an agreement. But if you spoke to the owner,
sure,
and they're like a reasonable person, that's where you're gonna cut the deal.
Yeah.
So that's like, if you give you an example, that's like
the like-minded,
that's our
nature of deal making and correspondence. Correspondence, not even deal making, but correspondence, like-minded nature. To your point, is always going to be more effective and valuable than it will if you're having someone who doesn't speak the lingo of that and other.
I mean, at the end of the day, my background is in sales and real estate, but it's really deal making. That's what I'm trying to do for our clients. Just trying to close the deal as fast as possible, and for the client as happy as possible. That's really what it comes down to.
Oh, it's very interesting. And then what strategies, rather, could we take and employ to mitigate risk and costs during these uncertain times for property?
That's a good question. I think, again, like speaking to, like, I know you have an insurance broker, having like, another third party just look at your policies, look at the properties, understand, like, do you have, especially since you're in Florida, what is your deductible? Things that you may not even think about. Like, if your roof needs to be replaced, what's your deductible on your wind coverage? Right. Is it too high? Is it too low?
Right.
Like, things like that. Understanding, and then also looking at your policy and understanding, are you buying extra endorsements for, I'll give you a simple example, like a backup. Most people don't think about that as like even something to think about. But if you have a multifamily building, I could tell you countless times this year, got a call in all across America, this happening.
Yeah.
People don't have adequate coverage. As a multifamily owner, people don't have adequate coverage for a basic thing, a backup.
Sure.
So those are things like, you want to speak to your broker and review the policy to make sure you guys have coverage there.
That's really helpful. And then what about in terms of risk retention? Like, what would you say is something that, we could do, as alternative options, as it relates to limiting the severity of the claims?
So I mean, that's a good point. And honestly, like we always tell people, like, if it's a smaller claim, whether it's a single family house or a commercial owner, if it's a smaller claim, don't put it in.
Right.
Like, don't put the small claims in, because that's going to eventually be a red flag on your, renewal or policy. So if it's smaller, something like you could eat, if it's under your deductible, or even if it's a little more, don't even consider putting it in.
That's a great point. I mean, that's a perfect segue for what we're struggling with in Florida, which is, even if it's claim worthy yesterday, doesn't mean it's necessarily claim worthy today.
Sure.
Because insurers want an excuse to remove you from their policy. Like, they want to, especially in Florida and kind of the Southeast as a whole. Any excuse they have to let you go, they'll take it. So, maybe you could talk to me about, what types of claims are the most popular ones that you've said a year or two ago, hey, I would go for that claim now, but you don't necessarily think that's so much.
So I think it depends. Every owner has a different risk tolerance.
Sure.
So we have some clients that for a smaller claim, they just want us to run the claim, because each property is tied up in a different LLC. So really, it doesn't matter. They don't have a master policy. I think it depends on a lot of factors. Like, do you have a master policy of the portfolio, or do you have single policies for your property?
Right.
Interestingly, another person we brought on the podcast, we spoke about that. Like, our first podcast he's a risk manager. So he was telling me that, it used to be that having a master policy on your properties was actually the way to go.
Yeah.
But now with insurance premiums skyrocket, it actually makes sense to get individual policies. It's worth looking into that, because you're not really getting a saving on the master policy. So I think it depends. There wasn't a claim 2 years ago. I told someone it just depends on the risk tolerance of the actual owner. Because some owners, I just looked at a property for someone in Iowa. Their deductible was $400,000. So I told them, I don't think it makes sense to put a claim in if it's, at least like $600,000 or $700,000.
Right.
It didn't make sense.
Right.
That's because their deductible played such a key role there. But
right.
It all depends.
Right. And to that point, actually today we got a call from one of our brokerage relationships that, one of the buyers won a deal, just got awarded a deal yesterday in Florida, because by the pure merit of insurance, and by virtue of insurance, due to the fact that their master policy was mostly out of Florida, out of the Southeast, out of risk. So they got the risk. They benefited from the low risk of their portfolio where it's currently based, and they were at close to $2,000, per unit cost on the premium, whereas everyone else was at $3,000. And that makes a huge difference when it comes to the loan proceeds, which then has a direct effect on your ability to pay up. So
yeah, that's
a story, that very real time story that I just heard this morning.
Yeah, that happens a lot. Like, you'll have these companies that come in and offer you better service. They also want to get a piece of your business there, but they have only one property there.
Right. Exactly. And so I think we covered a lot of different interesting topics. One thing I was actually interested in hearing a little bit about is, before I ask kind of a blanket question, like, what do you see the future, the biggest concerns are for the market, for the insurance world, if you will? What are some solutions that we could consider for risk? What are some things that you'd say, think about today, this third-party coverage, because there's frequent lower exposure to that issue than there is higher exposure to another issue. Like, what are some ways you would specifically, a little more in the minutia, a little more technical, but
Or like your property, or just like
for housing property, for a multifamily or residential home?
So I think it's to a point where I said earlier, it's, my advice would be, again, I'm not the expert in like this particular thing of mitigating risk, right? But we are the experts in the when it comes to property damage. But after, obviously, we read a lot and speak a lot of things. But I think it's looking at evaluating your portfolio, whether you have a Class A building or a Class B, whenever it was built, and think about things that, how you can protect the property, right? So if you have give you one example. If you have a property, do you have any properties that have like a central air, and then maybe the air handler of the property is like above all the units?
Sure.
So there's a very simple thing that we could potentially save thousands, if not hundreds of thousands of dollars of damage. The way most air handlers work is that you have it drips into a pan, like the condensate goes in there. So a lot of times owners don't have like what's called a wet switch on the pan. So if you don't have a wet switch on the pan, if that thing overflows or something breaks, all the water is going to overflow and go into all the units below.
Right.
For me, great claim, covered all day long. But for an owner, there's a way to mitigate that. All you have to do is have your HVAC guy install a wet switch up in that panel. So if there's ever an issue with the system and it starts overflowing, it automatically shuts the system.
Okay.
So that's a way you can mitigate risk. Like one specific example, but I think that's something you could do on your house, your condo, or you could do on your building.
Right.
I've had millions of dollars of damage from just that. So that's a way. And then what if you do have that, and then you tell your insurance company you have that? It's actually, you probably might be able to get some type of saving there on your premiums. I would bet, because you're showing them you have some protective measures in place, to prevent further damage.
Very interesting. That's very helpful.
We put out a question last week. If anyone had any comments or questions for us to talk about, and I'll point out Max Belkin, who he works with a company who specializes in remediation of aluminum wiring. I don't know if you've come across like any properties when you've looked at.
Sure, mostly our 70s property, 70s,
1960s. I did a little research so I could be a little more on the topic, but basically his company, if you are, let's say you own the property, even looking to purchase property that was built and had aluminum wiring, his company will come and remediate, will change the aluminum to copper. Most wiring is all copper.
Sure.
And the reason why, it's also this thing called stab block panels, but basically I had a conversation with him to learn a little bit more about this, but from 1960 to 1970s, and one of the main reasons he brought this up, he said that there were few insurance companies out there that are now, if you had insurance and you owned the property, that aluminum wire, they're not telling you, hey, Mark, 2024, we're not renewing your policy because you have aluminum wire. So what are you going to do? One, you could call Max, like that type of company, to remediate, to change it. But the real reason behind this, just kind of interesting, is that in the 1960s, it was after the Vietnam War. So copper, the real tool for wiring is copper. It was, not available. Right. So developers, when they were building out properties during those 10-year span, they started using aluminum because that was cheaper material, and they didn't know the fire risk that had.
Right.
So that's why these properties have aluminum, but
also the scarcity of materials.
There was no materials. Yeah,
there was no materials. So you had to be put in a position where they didn't know the level of exposure it would create for fire, but at the same time, it's all they had, to your point, and they had to do it on a wide scale. I don't want to quote a statistic, but most of Florida was built, and the southeast was built between 1960.
Probably see a lot of
1970s. So we see a ton of that. We used to primarily buy 70s deals and value add them and bring them up to make them look like
because what I was reading about, and he was telling me, is that if you do purchase these properties, and let's say your premiums, either it's very difficult to get insurance or they're just really high because it's high risk.
Yeah.
Once you show the carrier, the insurance company, that you actually remediated, changed it, you do get a pretty significant saving on your policy.
And lenders also are critical on that. Lenders are focused on it not only because the insurance company is, which obviously is a big driving force, but they also will let you have a smaller reserve. They'll alleviate,
it's a less,
because they know it's less risk. Because the reality is most 70s deals now, 60s and 70s deals, if they haven't already been remediated, there has been issues tied to it.
Sure, yeah.
And so, that's something that, with Illumicon, they call it, that, is a real issue right now. And a lot of guys bought, the last few years or several years at the height of the market, 60s and 70s deals.
Yeah, they're probably in trouble.
They're in trouble because they have to now remediate that just to get an insurance quote. Not even to find your pricing, just to get the quote itself.
Probably very few carriers that want to give insurance.
Yeah, there's only one real carrier that's out there that's doing a kind of a full coverage package. So that's something very real. I think that the same applies to plumbing, galvanized. You have galvanized plumbing, same issue. We had to rip out concrete on the sidewalks. It fully disrupted the property, disrupted parking spots at our properties. But we had to because the galvanized plumbing was leaking.
We have a claim right now up in that's actually the claim I mentioned in Daytona Beach earlier.
Sure.
It's actually because of a leak. There was a broken pipe in the slab. It's covered claim, and turned out it's all that type of plumbing.
Yeah.
So now they're trying to get the carrier to replace all the plumbing in the property.
So that was something I was, myself and my partner Eitan, we were hyper focused on since we've been buying deals, and no one would bring that up into really conversation. We just kept saying, "Is there galvanized plumbing? Is there Lumicon wiring? Like, talk to us. What's going on at the property?" They were like, "You guys are asking good questions because these aren't things that we really harp on. These are just things that you look on once you get to DD, and that's it." But now these are questions you have to ask from the very get-go of the conversation.
Sure.
So. That's a very good point. And I know Max Belkin, great group. And, there's a lot of folks out there that are helping to resolve these issues with galvanized plumbing and aluminum wiring. And, it's never been a more relevant time to call them. So I would say give them a holler and start socializing with them, at least what the pricing would look like, because
Get educated on the subject.
Exactly. Because the last thing you want to do is have to learn about something when you have to make a decision, and then there's a gun to your head. There's a time gun rather to your head. So that's a great point.
Listen, thanks a lot for coming in on our podcast. Hopefully, people watch, they learn something new. I learned something new. Yeah,
it's awesome. Also, it's really cool to see our different career paths over the years, both on a friendship and a professional, personal level, and be in your awesome studio here. I know most folks can't see it, but This is a really cool studio. Awesome. Thanks so much, and appreciate you guys.
Thank you.